Independence of monetary policy is a critical element for its success. My opinions and decisions will be based on my analysis of the macroeconomy and what's best for its long-term stewardship.
Hello and welcome to the Week Ahead on Nomura Podcasts. I'm Dominic Bunning, Head of G10FX Strategy at Nomura in London, and today is Friday, the 5th of September. We're recording this podcast mere hours after the latest US labour market report, which surprised markets to the downside with slower job gains, downward revisions to prior data, and a rising unemployment rate. After a quiet August, we're now in early September potentially starting to see some volatility kick into financial markets. The weaker US economic data appears to be putting renewed downward pressure on the dollar, as do some of the underlying risks around Fed independence, despite the comments you heard at the top of the pod from CEA Chair and Fed Governor-in-Waiting Stephen Miran in his Senate hearing that he delivered on Thursday. We'll discuss all of this with Jeremy Schwartz from our US economics team in a few moments, as well as his team's inflation forecast for the week ahead. Elsewhere, long-dated bond yields have been surging with increasing concerns about the interaction of political risk and fiscal sustainability in places as diverse as France and Japan. We're joined by Andrei Szczepaniak and Yuichiro Nozaki to discuss the latest political developments in their respective economies and the implications for the ECB and the BOJ. Southeast Asia has not been immune to rising political tensions either, with Indonesia and Thailand standing out on this front. So we've got Yuban Parasueles on to give his views about what's happening there and elsewhere in Asia. Markets are moving again and the lazy summer feel is gone, especially in rainy London. So it's time to strap in and get stuck in. Well, we're going to start this week in the US, just hot on the heels of the latest employment report. We've got Jeremy Schwartz from our US economics team here to dissect the data. Jeremy, the market's kind of reading this data as pretty dovish. We've had a headline miss. Bonds have rallied, bond yields are down. The dollar's sold off as payrolls has kind of come out. What's your more nuanced economics take on the US data here? What's it telling us in terms of the labour market, but also what's it telling us potentially about the Fed?
Yeah, so great to be back on the podcast. I think, the market's initial read of the employment data is more or less correct. This is a weak report. Just 22K on headline payrolls, really confirming the slowdown we've seen over the past 4 months or so, and even some negative revisions, which actually took the June number below zero. So that's the first contraction in a monthly payroll print since late 2020. Beyond that, you have pretty terrible breadth of job gains across industries. Education and health and leisure and hospitality continue to essentially be carrying the weight of the entire labor market, while other more cyclical sectors are either treading water or actually contracting outright. Meanwhile, the underemployment rates, U6, which includes discouraged workers and people who are part-time but would rather work full-time, rose to 8.1%. That's the highest in a few years. And you had a revision lower in the work week, which means that labor income growth is a little bit softer than we were thinking, despite a pretty solid month-on-month print for wages. That said, despite all these signs of softening, there's still the one important missing factor, which is that it doesn't seem like the labor market is stressed yet. So measures of layoffs are still relatively subdued. As long as workers aren't losing their jobs, then we don't see as much risk that the unemployment rate spikes higher from here. We think gradual cool down remains the base case at this point. And while you're very close to something that you might think of as stall speed, and the risks are clearly building to the downside, we still haven't seen that catalyst that we think would really drive the Fed to be more reactive and start to behave as if they're behind the curve and need to cut quickly in order to step in and stabilize a deterioration.
Thanks, Jeremy. I think that makes a lot of sense. And from a market's perspective, we've been leaning toward this idea the market would react more to any negative surprises, just because it does increase that left-hand tail risk. But certainly interesting to you say that really under the surface, it's more still this softening story that's happening rather than anything more acute. I guess the other thing that the Fed obviously has to focus on is not just the labour market, it's also the inflation side of the mandate. We've got CPI data coming out next week. What are we thinking there?
Yeah, so we think CPI is going to continue to challenge the Fed. We're forecasting a core CPI reading that's still elevated at 0.336% month on month, so even a little bit higher than the advanced reading for July. We think higher goods prices are likely to be the culprit here, with tariffs pushing up goods prices broadly and even some participation from autos, which have been a laggard as manufacturers have been reluctant to raise prices. Beyond that, we think that rent disinflation has probably stalled out at this point. So that had been a major driver of disinflation and a source of optimism from Fed officials. But we think you're sort of approaching the terminal run rate there, and you're unlikely to get much incremental impact from the lagged impact on housing. So overall, if our forecast is correct, we would get a core PCE reading of around 0.34% month on month. That's the highest since February this year. So along with signs of strong wage growth, some signs that inflation expectations are maybe beginning to pick up as well. We really think the Fed can't be complacent about inflation and just focus on the labor market side of the mandate. We continue to expect that they will go ahead and deliver some insurance cuts at the upcoming meetings, but we think they probably have to stop short of thinking about something like a larger 50 basis point cut or even consecutive cuts at the final 3 meetings of the year.
Yeah, I mean, that makes a lot of sense economically. I guess from the Fed's perspective, or the market's perspective of the Fed, is it's not necessarily just the data that we need to think about. It's also the sort of political pressure that might be being put on the Fed increasingly. We've sort of heard from Stephen Miran, who potentially is going to be on the committee as of September. We've seen what's happened with Lisa Cook. I mean, how seriously do we really take the risk that the Fed does start to lose operational independence? Is that still some way off in your view?
Yeah, so it's certainly a risk, and a risk that's increasing. You saw the Myra hearing before the Senate Banking Committee, where by and large Republicans on the committee appeared to support him, even though there were concerns about his potential independence with the news that he would actually keep his job at the CEA and only take a temporary leave of absence. So again, the Senate is maybe less of a circuit breaker than you might have hoped for from the Fed's independence perspective. We're likely to receive some news of a temporary injunction on Lisa Cook's firing relatively soon. That will be a very important decision in terms of the near-term composition of the Fed. Our view here is this still remains a somewhat distant risk in the future. So Trump can kind of move around the margins, making some personnel changes, but that's unlikely to shift the weight of the FOMC for the remainder of this year, at least, where officials have been inclined to show some more independence, and regional presidents in particular have been relatively hawkish, sounding even skeptical of a September rate cut as Powell tried to build the consensus around that post-Jackson Hole. So again, I think it's something that we certainly need to keep on our radar screen for 2026, but probably unlikely to be a decisive factor for the final few meetings of this year.
Yeah, I completely agree from our side as well. It's something that's very hard to trade directly from a currency perspective, but you sort of have this underlying theme that the dollar sort of has this almost urge to soften because of these underlying risks that are going to sort of continue to play out, but certainly not as pressing, I don't think, as the political risks we're going to discuss elsewhere around the world later in the podcast. So, Jeremy, thanks very much as always for your time. Great to hear from you. Well, we're going to move over to Europe now, where there's a different type of political pressure and also plenty of central bank focus. I'm joined once again by Andrzej Szczepaniak, our European economist. Andrzej, thanks for coming on. I guess for us, the big focus is going to be Monday and France with the vote of confidence in the government. Can you just give a quick overview of what is going on and what we expect to happen from this vote?
Hey, Dominic. As you say, exactly, the key focus really is going to be Monday, this vote of confidence. Essentially, Bayrou, the French Prime Minister, has been trying to enact some sort of fiscal consolidation in France, owing to the fact that the deficit has been fairly elevated of late. And as a result of the elevated deficits, the European Commission put France into excessive deficit procedure measures, essentially trying to get the deficit on a healthy trajectory and below 3% over some sort of time horizon, ideally by 2029 if all goes well. It's worth bearing in mind in terms of the 2026 deficit, Bayrou wants to reduce it by 44 billion euros, and also controversially, he wants to remove or abolish 2 public holidays. He's faced a lot of opposition in response to this by the sort of main parties in the parliament, and so owing to that, he's sort of called this vote of confidence, which he's now very widely expected to essentially lose. And so the question then is, if he loses this vote of confidence, what happens? How do markets react? Obviously, the first question. The second question is going to be, what does President Macron do? Our expectation is that Macron will try to find a replacement prime minister, again, a centrist person, to try and undertake some of these fiscal consolidation measures. Some people have sort of raised the question or the prospect of snap elections. We don't think that'll happen, certainly at this stage. Others have raised the question about whether or not President Macron himself could resign. Again, that's not at all our base case. From our perspective, it's really a case of Macron will try to first and foremost find a replacement, and at the margin, in maybe one of the sort of worst case scenarios, you might end up seeing a bit less fiscal consolidation eventually versus what Bayrou himself was attempting.
Yeah, and I think it's really interesting you talk about there's a difference, I guess, between market implications, economic implications. In FX, we've been pretty sanguine, really, about the impact on the euro as a whole, because we do have certain backstops in terms of contagion effect across the rest of Europe. We've got a relatively healthy fiscal position elsewhere in Europe, so France in isolation doesn't necessarily hurt the euro that much. And also, other economies have pretty bad fiscal positions as well. So when you're looking on a relative basis, it's maybe not that bad. But from a bond market perspective, I know you've been speaking to a lot of clients and run some surveys and things. Are you getting a sense that we're going to see a bit more widening in sort of French bond spreads? And is there a risk of a French downgrade incoming?
Exactly. So we run a survey, and essentially there's a clear consensus that Bayrou's government will lose that vote of confidence, and B, we will see a further widening of up to 20 basis points versus the sort of levels where we sort of started that survey. So the O80 Bund spread was around 80 basis points when we ran that survey, and so essentially our clients think that we could see O80 Bunds widen further to around 100 basis points. In terms of the sort of fiscal downgrades, credit rating downgrades, we do have Fitch on the 12th of September, so only a couple of days after that all-important 8th of September vote of confidence. At this stage, we're not really expecting Fitch to downgrade them imminently, and that's largely owing to the fact that already Fitch was expecting Bayrou's government to fall and was expecting already for there to be new snap elections over the course of the second half of this year. So essentially, what's happening is actually broadly in line with what they were expecting already back in March. So that shouldn't really be the catalyst for a downgrade at this stage. But clearly, the fact that the government is struggling to rein in that deficit means that we should be expecting downgrades over the course of next year.
Great, thanks, Andre. Well, you mentioned the 8th being the vote, and obviously the 12th being the S&P. On the 11th, of Thursday, that is, we've got the ECB meeting as well. Now, I guess very unlikely that we hear much from the ECB, if anything, in terms of what's happening in France. Maybe there'll be a question on it in the Q&A. But in terms of core policy, it seems like the ECB is pretty much where they want to be. Can you give us some insight into what you expect from this meeting, both in terms of rate decision itself and some of the forward guidance?
Exactly. I think when you think about sort of the macro backdrop in Europe at the moment, inflation, it's basically at target. It was 2.1% in August. That's basically at target. The ECB's obviously target is 2%. In terms of activity data, that's sort of ticked up over the course of Q3 so far relative to Q2. In terms of the labor market, that shows some resilience. Where monetary policy currently is, the depo rate, it's at 2%. It's essentially the midpoint of where the ECB sees neutral. And so from that perspective, the ECB is in a very good place to simply leave rates as is and to sort of wait and see and evaluate how the data sort of transpires over the coming months. In terms of the guidance, we think Lagarde will emphasize what she said already at the July meeting. That is that the ECB is well placed to navigate the upcoming or the sort of current uncertainty stemming from US trade policy and broader US policies. And so from that perspective, it's essentially the ECB's in wait-and-see mode. It's data-dependent. It is going to essentially do meeting by meeting. And in our own view, at least, we're not expecting any near-term change in the policy rate from the ECB.
Great. Thanks, Andre. So plenty to look forward to in Europe. Really appreciate your time. Speak to you soon. Now, moving on to Asia, and specifically ASEAN to start with, I'm joined by fellow podcast host, Euban Palazuelos, who's going to talk us through the local politics there, as well as the macro implications. Euban, thanks for coming on and being the other side of the mic for once. Look, politics is dominating in a lot of places. ASEAN doesn't seem any different from my perspective, at least. Let's start with Indonesia. What's the latest that's going on there, and how is it impacting, if at all, our macro outlook?
Yeah, hey Dom, thanks for having me. Yeah, definitely politics in this region have been a focus for us in the last week or so. In Indonesia, it's been widely reported a lot of protests happening there since last week, which turned really worrying and violent over the weekend, prompted the president to initially cancel his trip to China. But anyway, he went ahead a day later. And then he addressed the country to try and appease protesters. These are mostly students, labor unions, and even ride-hailing drivers. One of them tragically died during one of the protests, and that inflamed the tensions even further. This week seems like calm has returned a little bit. There were some smaller protests, but relatively peaceful. But from my perspective, I think the risk of recurrence in the coming months is still relatively high. Again, this is reflecting growing public discontent in terms of economic conditions in Indonesia. Sentiment has certainly been fairly fragile. In our view, some of these demands, including raising wages and labor markets or changing the labor law, might take a while to resolve. So in terms of the implications on policy, I think the risk here is the government turns towards more populist measures, which could add to some fiscal pressures. But also could dim some prospects of structural reforms. In terms of monetary policy, the central bank has been actually intervening quite a bit in FX markets to stabilize the IDR. But the risk that we see here is the rate cut that we expect by BI in September might be delayed if these FX pressures persist.
Yeah, I know our guys in FX have certainly been positive on the IDR, so it's been a little bit of a challenge, but seeing BI step in certainly helping that view a little bit more, I think. Thailand's also not a stranger to political challenges over the last few years, at least. It seems like there's a little bit more pressure picking up there as well. Do you want to talk us through what's happening in Thailand? And again, are there any major macro implications?
Yeah, sure. So what happened last week was the prime minister was dismissed by the Constitutional Court. Related to the leaked phone call with the Cambodian leader, where she was apparently criticizing the Thai army in relation to the Thai-Cambodia border dispute. So that was the cause of her dismissal. Now, where we go from here, it's really pretty interesting. So because her own party doesn't have the numbers, and then there's a competing faction called the Bumjai Thai. They now need the support of the opposition party called the People's Party, which is the largest in parliament. And as it turns out, the People's Party have expressed their support for BJT. So that means the leader of the BJT, Anutin, is likely going to get the vote in parliament as we speak today. To be the next prime minister. But the tricky part here is for the People's Party support to be given to Anutin. One of the conditions they set is BJT has to call an election within 4 months. So I think the risk of an early election doesn't really necessarily resolve the political situation. Uncertainty will remain very high because in that scenario, we could easily see People's Party winning the election. And they are on a platform of reforms which the conservatives and the establishment may not necessarily like. So as we saw in the last election, they actually won it, but they were prevented from forming the government because of these countermeasures. So again, the election is not going to solve the political stalemate that we're in. And then in the meantime, the economy is pretty weak. So the uncertainty that comes with it hits it even more. Plus the fact that, fiscal execution, budget execution could also add to a drag on growth. So it's really the central bank that has the ability now to sort of provide some support. And so this is why we think there's more rate cuts coming by the Bank of Thailand this year. We think the other risk is a ratings downgrade. We think Moody's, which now has a negative outlook on Thai sovereign credit rating, could potentially pull the trigger of a one-notch downgrade few quarters from here.
Thanks, you've been really clear as always. I guess politics, we also have to think about tariffs and trade wars and all those things. India's definitely been in the highlight, in the zone there for some time, but not a lot of progress, even some negative developments potentially. But I think more broadly, how is Asia sort of getting hit by tariffs at the moment? I know we've got some export data coming out this week, might be worth looking at. How are you thinking about that? And is there any other sort of data you want to flag for the week ahead?
Yes. So we've got the Korea export numbers actually earlier this week, and everyone was watching it very closely because this was for August, right? And just trying to gauge the impact of the U.S. tariffs. And so far, it's been holding up. And that's what we expect to see as well for the trade numbers from China and Taiwan out this week. On a headline basis, yeah, it's softened a little bit. Or that's at least that's what we expect, but it's not a major drop, right? So, for example, in Taiwan, we're still expecting export growth at 29.5%. So, I think that's partly reflecting some of the resilience from the AI-related demand for electronics. So, not quite as evident yet in terms of the impact of the tariffs on exports for Asia. As you mentioned, we have some inflation numbers as well for China and India next week. A little bit divergent. In China, we see it potentially going back to negative territory, minus 0.2, mainly because of food. And in India, we expect headline CPI to pick up to around 2.4 from 1.6, also because of food. But again, 2.4 still remains pretty benign.
Interesting. So quite interesting stories there between the two biggest economies in Asia, and obviously lots of political developments to keep an eye on, as we discussed. Thanks a lot, Yuban, as always, and we'll speak to you soon. Well, we're going to move to Japan to finish. We've spoken about politics in ASEAN and Europe, but Japan has certainly got some political news to talk about as well. I'm joined by Yuichiro Nozaki, who is one of our economists in Tokyo. And Nozaki-san, thank you very much for joining us. Can you explain to us what is it really that's been happening in terms of politics in Japan over the last week, and what's sort of coming up over the next few days?
Thanks. On September 2nd, the LDP, Japan's ruling party, put together a report analyzing why they lost the dry upper house election. As the result of this election, LDP and ruling party lose majority seats in both upper and lower house. Following this report, key party leaders, including the Secretary General, announced they would resign. However, Prime Minister Ishiba said he plans to stay in office. So for now, the party is still running under the same leadership, including those who said they would step down. Looking ahead to September 8, next Monday, there's a signature campaign pushing to bring the party's leadership election forward. If the signature in favor exceed half of the total 324 votes from LDP Diet members and prefectural representatives combined, a leadership election will be held, even if Prime Minister Ishiba doesn't resign himself. While many opinion polls show more people want Ishiba to continue, since early September, efforts to remove him have been picking up speed. A survey by major Japanese media on September 4th asked Diet members, and although more than half didn't reveal their stance, over a third supported holding the leadership election early. The situation is still fluid heading into next week, but there's a real chance that the election will be moved up. All eyes are on their result coming on September 8th.
So Monday's a big day in Japan, a big day in France. In terms of the potential candidates, if this does sort of play out and we do get the leadership election, how are you thinking about the potential candidates in terms of maybe policy, who is involved and what might they be pushing in terms of their policy agenda?
Firstly, according to the various media reports, if the leadership election happens, voting will likely take place in early October. The main candidates expected to run are Ms. Takaichi, the former Ministry of Economic Security, and Mr. Koizumi, the current Minister of Agriculture and also the son of former Prime Minister. In terms of policies, Ms. Takaichi supports fiscal expansion and monetary easing, and recently she has advocated cutting consumption taxes. However, she hasn't talked much about monetary policy recently. With inflation still continuing, it might become harder for her to keep support for maintaining low interest rates for a long time. Mr. Koizumi is expected to follow a similar economic approaches as Prime Minister Ishiba. It's also worth noting that Ishiba might still run for re-election. No matter who becomes Prime Minister next, the ruling party does not have majority in both houses, so managing policy will likely remain difficult.
Yeah, it does seem like markets are focused quite a lot on this battle, I guess, between potentially Koizumi and Takaichi. And certainly from a yen perspective, we've seen some concerns that Takaichi could be quite dovish and could weigh on the yen. So I think that's definitely a tail risk, which has kept investors a bit more cautious on the yen. But when I look at sort of monetary policy and the backdrop of the economy, it still seems there's a pretty good rationale for the yen to outperform. I mean, as we record this, we've just had some pretty strong wage data. How are you guys thinking about the BOJ at the moment?
On monetary policy, early of this week, the market had roughly 70% chance priced in for an interest rate hike this year. But that's dropped to about 50% recently. This is not only because of the political uncertainty I mentioned, but also because the BOJ's Deputy Governor Himino gave a more dovish speech on Tuesday than the market expected. Mr. Himino gave a cautious view about the impact of Trump tariffs, saying the effects could be bigger or smaller than expected. But for now, it's important to watch for the possibility of a bigger impact. In October, the BOJ will release several important quarterly surveys, but these data are all soft data. It will somewhat challenging for BOJ to assess the tariff impact based on hard data by October meeting. Of course, Mr. Himino didn't rule out an early rate hike in this year, so the October meeting remains a live event. However, my current take is that expectations for October meeting had gotten too high to begin with. Nomura's main forecast still points to a rate hike in January 2026.
Thanks very much, Nozaki-san. Very, very clear. So lots of events going on in Japan. We've got the potential leadership election in October. We've got the potential BOJ rate hike in October, but certainly a lot of things to think about. Thanks a lot for your time and have a great weekend.
Thanks.
That's it for now. And thank you again for listening to our podcast, which is edited and produced, as always, by John Dalton. Please do like and subscribe to Nomura's podcast on Apple, Spotify, SoundCloud, or wherever it is you usually get your pods. We'd love to hear your feedback, so please do feel free to write a review and share the podcast far and wide with anyone you think might be interested. You can also check out nomuraconnects.com for more of our research and updates. Thanks again, and good luck for the week ahead.
In a complex and unpredictable world, where a sunset in one market means a sunrise in another, one investment bank always looks beyond the horizon to help our clients release the potential of tomorrow, today. Nomura, connecting markets, east and west.
Disclaimer. This content has been prepared by Nomura solely for information purposes. It is not intended to form the basis of any investment decision and is not an offer or solicitation of an offer to buy or sell or enter into any agreement with respect to any security, product, service, including but not limited to investment advisory services or investments. The opinions expressed in the content do not constitute investment advice nor is legal, regulatory, accounting, or tax advice and may change at any time without notice. You should seek independent advice as appropriate for individual circumstances. For further information, disclaimers and disclosures, please visit Nomura Connect at www.nomuraconnect.com.